Welcome. If you've been hearing the buzz about passive funds and wondering what all the excitement is about, you're in the right place. Today, let's demystify passive funds, one of the hottest trends in investing, not just in India, but around the world. These funds are making headlines for their simplicity and effectiveness, and more investors are taking notice. Traditionally, investors would spend hours researching and picking individual stocks, like Reliance, TCS, or HDFC Bank, hoping to find the next big winner. But with passive funds, you don't have to make those tough choices. Instead, you invest in a ready-made basket of top companies, all at once, with just a single click. These funds simply copy or track a market index, such as the Nifty 50 or the Sensex. Think of an index as a curated list of the most important companies in the country, representing the overall health of the stock market. So when you invest in a Nifty 50 index fund, you're not betting on just one or two companies. You own a slice of all 50 top companies in India, from tech giants to banks to consumer brands. This gives you instant diversification and reduces your risk. The fund's job is simple, just mirror the index's performance. There's no guesswork, no trying to outsmart the market, and no complicated strategies. The goal is to match the returns of the index as closely as possible. If the Nifty goes up, your investment goes up, minus a tiny management fee. If the index drops, your fund drops too. It's a transparent, straightforward approach that takes the stress out of investing. There are two main types of passive funds you'll come across. Index funds, which you buy directly from the fund house, and exchange-traded funds, or ETFs, which are traded on the stock exchange just like regular shares. ETFs offer flexibility and can be bought or sold anytime during market hours. For most beginners, index funds are the simplest way to start. You don't need a demat account, and you can set up automatic investments every month, making it easy to build wealth over time. Active fund managers try to beat the market by picking stocks and timing trades, but research shows that even the experts struggle to consistently outperform the index, especially after fees and taxes. The core idea is simple. Beating the market is tough, even for pros. Most active funds underperform the index over the long run. So why not just match the market and enjoy steady, reliable growth? This approach, championed by John Bogle, the founder of Vanguard in the US, has revolutionized investing worldwide. Now it's transforming how Indians invest too. Passive funds are making wealth building simpler, cheaper, and more accessible than ever before. With lower fees and less hassle, more Indians are able to participate in the stock market and grow their savings. So, whether you're a student, a young professional, or planning for retirement, passive funds offer a smart, low-cost way to invest for your future. Let's see how this philosophy is changing the game in India. To truly grasp the difference between passive and active funds, let's use a simple analogy that everyone can relate to. Imagine you're in your kitchen, ready to bake a chocolate cake. The process of choosing how to bake this cake is a lot like choosing how to invest your money. Picture yourself gathering all the ingredients: flour, sugar, cocoa, eggs. You could try to bake the cake yourself, or you could bring in some expert help. You might decide to hire a star chef, someone with a reputation for creating extraordinary cakes. This chef is like an active fund manager, promising to deliver a cake that's better than any you could make on your own, but charging a hefty fee for their expertise and creativity. Active funds work in much the same way. The managers constantly analyze the market, pick stocks they believe will outperform, and try to beat the average returns. But all this effort and research comes at a cost: higher management fees and sometimes more risk. Now, let's consider a different approach. Instead of hiring a chef, you simply follow a tried and tested recipe from a cookbook. You measure each ingredient exactly as written and follow every step to the letter. This is the passive fund approach. In this analogy, the recipe book represents the market index. The passive fund manager's job is to replicate the index as closely as possible without trying to add any special twists or secret ingredients. Because there's no need for expensive chefs or elaborate techniques, the costs for you, the investor, are much lower. You're not paying for someone to try and outsmart the market just to match it. Over the long run, these lower fees can make a huge difference. Even a 1% difference in annual costs can add up to lakhs of rupees more in your pocket after several decades, thanks to the power of compounding. Of course, the active chef might occasionally whip up a masterpiece, a cake that's truly exceptional. But there's always the risk that the experiment goes wrong, and you end up with a flop. Similarly, active funds can sometimes outperform, but they can also underperform, and you never know which you'll get. With passive funds, you know exactly what you're getting. The market's return, no more and no less, delivered at a fraction of the cost. There's comfort in that predictability, especially for long-term investors. For most investors, this straightforward, low-cost approach is a winning recipe. It's simple, reliable, and over time, it often leads to better outcomes than trying to chase the next big thing. So, when you're deciding how to invest, ask yourself, do you want to pay more for a chance at outperformance or pay less for steady market-matching returns? The choice is yours, but the evidence increasingly points to the benefits of the passive approach. That's why passive funds are gaining ground around the world, and more investors are choosing this path for their long-term goals. In the next section, let's see how this shift toward passive investing is playing out right here in India, and what it could mean for your financial future. Passive investing is booming in India. Just a few years ago, passive funds were niche. Now, they make up 21% of all equity mutual fund assets. That's a huge leap, and the pace is only accelerating. In just 1 year, assets in passive funds grew by over 20%, crossing Rs 11 lakh crore. Globally, the US has already seen passive funds overtake active ones. India is following fast. Experts predict passive funds could hit 30% of equity assets by 2030. What's driving this? More product choices, lower costs, and new SEBI rules making passive funds even more attractive. Like the rise of online shopping, passive investing is becoming the default for a new generation. The data is clear. This is a long-term shift, not a passing fad. Indian investors are embracing simplicity, transparency, and low costs. Why are passive funds winning over millions of Indians? First, ultra-low costs. Active funds charge 1.52% in fees. Passive funds can be as low as 0.10.2%. Over decades, that fee gap can mean lakhs more in your pocket. Second, simplicity. Passive funds are easy to understand. Just track the index, no surprises. Third, transparency. You always know exactly what you own since index compositions are public. No hidden bets, no black boxes. Finally, performance. Many active large-cap funds struggle to beat their benchmarks after fees. As markets mature, this gets even harder. So why pay more for uncertain results? Passive funds offer low cost, clarity, and reliable market returns. That's a powerful combination for today's investors. It's no wonder passive funds are becoming the go-to choice. Let's talk about how to get started. When it comes to building wealth steadily and with minimal stress, the best way to invest in passive funds is through a systematic investment plan, or SIP. Think of an SIP as your personal autopilot for investing. Once you set it up, it quietly works in the background, helping you grow your money without constant attention or worry. With an SIP, you commit to investing a fixed amount every month, just like paying a regular EMI, but this one is for your future self. The process is automatic, so you don't have to remember to invest each month. The money is transferred directly from your bank account into your chosen passive fund. This simple habit not only builds your savings over time, but also removes the emotional ups and downs that often come with investing. You don't have to worry about whether the market is up or down, or second-guess your decisions. SIPs use a smart strategy called rupee cost averaging. This means you automatically buy more units when prices are low and fewer when prices are high, helping you avoid the risk of investing a lump sum at the wrong time. Over the long run, this approach smooths out your average purchase price and reduces the impact of market volatility. It's like planting a seed and watching it grow steadily, even if the weather changes from time to time. The beauty of SIPs is that you don't need to time the market or react to every headline. You simply invest consistently, no matter what's happening in the news or with the economy. Even if the markets are at all-time highs, starting an SIP means you'll benefit from both the upswings and the inevitable corrections. Over time, you capture the full journey of the market, not just a single moment. The combination of SIPs and passive funds is a powerful, low-stress way to build wealth. It's a strategy that works quietly in the background, letting you focus on your life while your investments grow. Because it's automated and disciplined, SIPs are perfect for long-term goals, like buying a house, funding your child's education, or planning for retirement. You set your goal, start your SIP, and let time and compounding do the rest. For most people, this is the simplest and most effective investment strategy. You don't need to be a financial expert or spend hours tracking the market. Just stick to your plan and watch your wealth grow. Start small if you need to, but stay consistent. Over time, even modest investments can add up to a significant amount, thanks to the magic of compounding. Think of passive funds and SIPs as your all-weather wealth-building team. Reliable, steady, and always working in your favor, no matter what the market is doing. Now, before you get too excited, let's take a look at where you shouldn't go overboard when investing. While broad index funds are rising, thematic and sectoral funds are losing steam. These funds focus on specific industries like banking or IT, or hot trends like electric vehicles. They were popular when certain themes soared, but now, many investors are cashing out. The reason? Thematic funds are risky and volatile, great for a small tactical bet but not for your core portfolio. Think of index funds as your daily balanced meal. Thematic funds are dessert, nice occasionally, but not every day. Most investors now prefer the stability of broad-based funds like Nifty 50 or Nifty 500. The lesson: build your foundation on diversified, reliable products. Use thematic funds sparingly, if at all. The core satellite approach, with passive funds at the core, is gaining ground. That's a sign of a maturing investor base. With basic index funds now ultra-cheap, fund houses are innovating. Enter smart beta or rules-based funds, a blend of passive and active strategies. These funds track indices built on factors like momentum, low volatility, or quality, not just company size. For example, a Momentum 30 fund invests in the 30 stocks with the strongest recent gains. Smart beta funds offer low cost and transparency, but with a strategic tilt. You can now build a portfolio tailored to your style, without relying on a fund manager's hunches. Fund houses are creating a passive supermarket with options for every need. This innovation gives investors more tools to build cost-effective, rules-based portfolios. The passive space is more dynamic than ever. Equity passive funds are booming, but debt and international passive funds are also evolving. Target maturity debt funds, TMFs, invest in bonds that mature on a set date, offering predictability and transparency, great for those seeking fixed returns. Growth here is slower, partly due to recent tax changes, but the appeal remains for safety-focused investors. On the global front, international passive funds let you invest in markets like the US for diversification. However, SEBI's overseas investment limits have caused some hiccups, with funds sometimes halting new investments. Some investors are now using the liberalized remittance scheme or gift city platforms for global exposure. Despite regulatory bumps, the need for international diversification is strong. Expect more solutions to emerge as demand grows. Debt and global passive funds are set to play a bigger role in Indian portfolios. The passive revolution is just getting started. The future of investing in India is increasingly passive. Explosive growth, shifting preferences, and constant innovation are driving a structural change. Passive funds could soon make up 30% of equity assets, powered by a new, savvy generation. For beginners, a simple Nifty 50 or Sensex index fund offers instant diversification and stress-free investing. Combine it with an SIP, and you're on autopilot to wealth creation. As markets mature, active managers will find it even harder to outperform, especially in large caps. Ongoing price wars and smart beta innovation will keep passive funds attractive for all types of investors. Passive funds are democratizing investing, making it accessible, affordable, and understandable. The power is shifting from fund managers to investors. The passive revolution is here, and it's here to stay.